everyone. Welcome to OpenLine. Glad you are with us. Tonight we're talking about money. We're talking about investing. In these difficult times, what might be the appropriate thing to do? Is something safe? You know, there's so many people that are concerned about what we're going through, where we are right now. So what should you do with your money? And so I always like having Paul Winkler on. So here is Paul Winkler, president and founder of Paul Winkler Incorporated, investment advisory firm all over Middle Tennessee. You're on a radio show.
Yeah,
so you know
25 years almost.
25 years on the radio.
You've got to be a glutton for punishment to do that.
I always learn something when you come on. And so we can talk about what you do, investment advisory firm, but what are you thinking about today?
Yeah, so financial planning in general. I mean, people spend more time planning their vacations than they do their finances, and it's going to be the longest vacation you ever take in retirement. So I always tell people you really need to sit down and plan this type of stuff. So often what happens though is the investment firms, the financial planners, they focus on tax issues. They spend a lot of time on Social Security, which is important, you know, and they talk about Medicare and those types of things. And a lot of times those things are lead-ins to product sales, unfortunately, because the industry is so driven by product sales. And that was one of the things that was a turnoff for me so many years ago. As a matter of fact, I was talking to a securities attorney today, and I made the comment that I said, this is something I want to expand. I want to, as I get older and my staff and all of us get older, I'm nowhere near retirement, but I'm always thinking ahead 20 years. But I would love for people, and she said, well, what do you want in a planner? I said, I want somebody that's sick of the industry. I want somebody that is just sick and tired. I want somebody that's seasoned. They've been in the industry long enough to know that it is corrupt, corroded, and there's a lot of bad stuff going on. And she laughed, and because as a securities attorney, you know she knows what I'm talking about, right? Right. So, you know, for me, that's a lot of it. You're focusing on those types of things, but I think a lot of times what goes by the wayside is people don't know what they're doing. They don't understand investing. They don't understand the concept. They think it's over their heads. And so often what happens is that makes them just absolute, you know, ripe tomatoes for the eating, right? Because, you know, you can, if you don't know how things work, then you can be sold just about anything. So I think a lot of times what I like to do is spend time educating, and that's what I thought we'd spend a little bit of time today, because one of the Channel 5 people asked me a question. It says, what do you do for safety? She and I got in this conversation. What do you do for safety? I mean, gosh, so many people I know are so worried about what's going on right now. And, you know, you had this week, and who knows where it's going to land, but you had gold, you know, come, you know, just, and people, what were they buying it for? They were buying it as a safety net, right? And it goes and takes this big dive down. So we got in that conversation, and the thing that was really interesting about the conversation was I started talking about, because I teach at schools around town, universities, schools, and I remember one time I was asked to speak, I think it was Mount Juliet High School, I think it was, if I remember right. Okay. And the teacher and the students, the thing that was on their mind was this, and this may sound familiar to you. What happens if China decides to ditch U.S. treasuries?
Boy, at a high school.
Yeah, do you remember that?
Oh, yeah.
Yeah, but you remember everybody was talking about that was going to be really scary. And I think it was, if I recall, I think it was during the first Trump presidency that was being talked about.
This was several years ago then. Okay.
Yeah, this was several years ago. And I said, well, okay, so what's the concern here? The concern is that the federal government borrows money. They issue treasury bills that are short-term notes, you know, when they borrow for a very short period of time. Then you have treasury notes, which are, you know, like 1 year, like 10 years, and then you'll have, you know, in maturity. And then you'll have treasury bonds, which are 10 years up to 30 years. And so you'll have varying maturities on these things, but the worry was that the Chinese government was going to get really mad at the U.S., and what they were going to do is they were funding a lot of our federal debt. Right. That was what the talk was. They're funding a lot of our federal debt. And if they decide to pull out, we're in trouble. Now, why would anybody think that we're in trouble? Well, the reason being is, A, you got to find somebody else to lend you money. But typically what happens is when you sell bonds, and all of a sudden you've gotten rid of whatever it is that, you know, the note that somebody owes you, that can drive interest rates up. And one of the big problems that we have is funding the debt, but also funding the interest on the debt is a big issue.
Sure.
So one of the things I pointed out to the class was this. I said, how much of the debt do you think that the Chinese hold? And they're like, 50%, they're coming up all these numbers. I said, would you believe it's like 7? And
7%?
Yeah, it was like 7% at the time.
Okay.
And they were like, is that it? Is that all? And I said, yeah, it's not as much as you might think. And I said, and the other thing is this. If you are the lender, if you're China, and all of a sudden you decide you're going to dump a bunch of treasuries, you are shooting yourself in the foot. Because what you're going to do is drive down the price of whatever you get. Because it's like you got a car lot. It's the end of the year, and you're trying to get rid of your last year models. You're going to have to drop the price in order to get rid of all the excess cars,
sure,
right?
Supply and demand. The more cars you put on the market, the lower the price will be. Yeah.
Same thing. So what ends up happening is that doesn't happen. They don't necessarily ditch out or stop or anything like that. That doesn't happen. But what did happen is fascinating. And it had the same effect, or it seems to be having the same effect. And that is, they decided most recently that they were going to, well, you know what? I'll show the U.S. What we're going to do is we are going to buy gold and get rid of the treasuries. And we're going to replace, instead of holding treasuries, which would be, safe and stable, right? We're going to buy gold.
So China said that.
Yes.
Okay.
And that is very widely believed as to why gold has gone up so much recently.
Wow.
Is because of their buying of it.
Okay.
At some point, that demand is satiated. At some point, we've got all the gold that we need, right? And we don't need any more. So we stop demanding it. When we stop demanding it, what ends up happening is price can come down. And like I said with treasuries, all of a sudden when treasuries go down in value because we're getting rid of a bunch of things, the same thing can happen with gold. And you think of it as a safe haven, it is not necessarily terribly safe, is the point.
You have said that on the show, that gold is kind of an emotional buy, but it is not a place that you would recommend putting a bunch of money in.
Yeah, it's a very high standard deviation. And in English, what that means is it's a lot of this historically. It has a standard deviation or a level of volatility that is pretty close to the stock market historically. Yet the rate of return is closer to treasury bills, which is what we call the risk-free rate, because treasury bills don't fluctuate in value. They just go straight up. So why would I want something that A, is as risky as the stock market, but B, as low returning as treasury bills? It's like the thing from with CNBC, I think I told you last time. The guy had the quote from CNBC, and he goes, fun little fact. He has this really uneasy look on his face. The 4,500-year return of gold is 0 after inflation.
Wow.
He said you could buy the same basket of goods 4,500 years ago, the equivalent of food, for example, 4,500 years ago in ancient Egypt, as you could today. So a lot of times what people do is they go for that to safety. The other thing they go ahead. You have a question.
It's interesting to me. I opened the show with so many people are worried about right now.
Right.
And then you're telling a story about how people were worried 8, 10 years ago.
What a great observation.
And so I wonder, so many people are worried right now. I think that's true. Yeah. But are so many people always worried?
Yes. I was just laughing when you said that, because I thought, what a great observation. You're right. Aren't we always worried?
You could open this show the same way 10, 20, a generation ago.
Right.
Everyone's always concerned.
Right.
We're looking around. We're concerned. And so what do we do about that?
Well, that's, it's the fear of the future. It's, the future is this blank slate that we don't know what is in it, and we will certainly fill it with something bad, hairy, and scary, as I like to say. We'll always come up with some scenario, and, if we don't have anybody to challenge it, around us, and a lot of times that's the job of the advisor, is to take your fears and challenge them, and say, hey, let's not a confrontation or anything. I don't mean that, but I just mean, let's think through this. What if that thing that you're worried about happens? Because if you look at the whole data on fear itself is what 70% of the things that we fear don't happen. of the 30% of the things that do happen, what they found in the research was that 90% of the time, so now we're down to 3%, and I'll get to that in a second. But 90% of it, we figure out, we find that we can handle it way better than we ever dreamt we were going to handle it. So it's not that bad stuff doesn't ever happen. It does. But, typically our ability to handle it is much greater than we give ourselves credit for. So most of the time we're literally worried about something either that's not going to happen or that we can handle. So where we get into trouble is where we act on those things.
And there's some times that people may benefit from having others be fearful. I think you say you plan more for a vacation than you do for your retirement.
Yeah.
Well, I understand my vacation.
Yeah.
I don't understand all this. A lot of I don't understand. So then I trust whoever I'm talking to. And that person may want to make me scared so that I'll do even more of what they're talking about.
True. So true. Yeah, that is so true. So often the advisors will scare people into investments that are really good for them, like annuities and those types of things that we talk about. Bitcoin is something that in the investing world is starting to jump on board. Some of the investing firms, there was one firm that was on TV the other day, and they said 30% of all these Bitcoin products are actually sold under our umbrella. And I was just shaking my head going, I wouldn't be bragging about that.
Because you're not into crypto at all.
Oh, gosh, no. It's not an investment. But you said something interesting about that it's good to have people that are fearful to some extent, and that's very true. You have to have a modicum of fear to keep you from doing stupid things.
Yeah, that's true.
That's not true. A bad point at all.
Well, so then what should we do? So with all that, there's always been fear about money. There's always been a misunderstanding sometimes, or people feel like it's complicated. The answer would be, generally speaking, what? Well,
there are things that we don't want to do. We don't want to go and chase safety all the time. I want to make sure you hit that, because I think about in terms of, I almost brought a football picture of me when I was in high school. I was the world's worst football player. That's why I went into the band. I was like, don't put me on the field. I was third string.
Please bring a football player next time. I could almost top you, but okay, I want to hear your football story. Okay, you were third string. Okay.
So I was lousy, and the reason I was lousy, I was playing not to be hurt.
Oh.
And so when you play not to be hurt, you're going to get hurt. And that is exactly what happens. And it's the same thing with investors. If they play not to be hurt, they go to CDs all the time. Well, CDs have huge problems with inflation risk. You're looking at rates of return of like zero, Treasury bills going back to the 1920s of 0.4 after inflation. You're looking at gold, as we talked about. You're looking at annuities, the abysmal rates of return. So what do we do? Well, the investment industry has an answer. And Denise may actually have a good slide for us on what their answer is, because it is what they actually say. You'll see the ads out there. There it is right there. And if you look at the various fund companies, there's Vanguard, there's American Funds, there's T. Rowe Price, there's I think we have Voya was another one on there, and State Street, and so on and so forth. They all say to do something that you always say, which drives me crazy: diversify. Right. Diversify. Right. You ought to diversify. And so you look at that slide and go, well, everybody's telling you to diversify. Well, what I thought would be helpful and instructive is to actually look at mutual funds that are managed by these companies and look at whether they're really diversified or not. So where they're choosing the asset allocation funds, what they're called, they're choosing the mix. Give me the next one, Denise. This is what is called a style box, and I've talked about this a number of times on the show, but it really bears actually looking at it. You see, the first one says Vanguard Life Strategy, the second one's Fidelity Asset Manager, third one says T. Rowe Price Spectrum. So these are mutual funds for people that just want to have these companies put the portfolio together. Now, the way you read this box, it looks like a tic-tac-toe box. The top set of boxes tells you that the fund manager is putting most of the money, or where they're putting that they're putting money in large companies. The middle set of boxes, mid caps. The bottom set of boxes is small. Now, if it were diversified, you would see fairly equal numbers between these boxes. But what do you see?
They're all in large. I mean, the large is predominantly where they are.
That is exactly what you're seeing. Those are all percentages is what you're seeing right there. The area of the market that you would expect the highest return, long run, would be the bottom left-hand corner, and both of them is 2 or 3%. That's it, is in that area. And by the way, in international markets right now, that is the area that had the top return so far this year. And yet, very little money is in that area at all. Next set of boxes. So it's not just those fund companies. You see American funds. You see Voya. Wow. You see State Street. And, you know, you see these companies and you go, well, wait a minute. What is going on? They're saying they're diversifying, but that's not necessarily what we're seeing. Now, what I want to do is explain why that is the case. So let's just jump to the next one and see if we can see it, Denise. Okay, this is harder to see, but I want you to notice that I have circles on the top boxes in all three of these. What these are right here is ETFs or exchange-traded funds investing in certain areas of the market. Number one, the Dow. Number two, the S&P 500. And number three, the NASDAQ. So when you listen to TV, and that's good enough. I think they got the point that the top set of boxes is filled in. So when you see or when you hear the investing world, or let's say brokerage firms or TV or radio, you know, you'll hear people talk about what did the market do today? What are they announcing on? The Dow, the S&P 500, and the NASDAQ. So they're literally, what they're doing is these fund companies are tracking those three market segments because that's what you think the market is.
Right, yeah.
And you go, well, why would they do that? Do they make more money? In a really weird way. Because let's say that those markets, large U.S. stocks, large international stocks are up, and the mutual fund they manage is up a like amount. Will you stay with them? Will you go, I'm happy with these people? Yeah, you will. I'll stay. They're cool. They're great. My money's, I'm growing. And you hear a lot of people so far this year, I'm doing really, really well this year, right? You've heard that. Now, if the market's down, you know, let's say you've got 2022 or 2008 or 2002 or you know, any of these years where you had the market was down, right? And my portfolio is down, what is everybody saying? Oh, market's down.
Yeah.
But you know what? Markets go up, they go down. Sit tight, stay the course. You'll be okay. It'll come back, and you'll hear. And that's true.
It's so if the market goes down, they don't look bad, really, when their stuff goes down. So that's very interesting.
Yeah.
They tie it together. All right, we have to take a break, but then I want to come back and continue this.
Yeah.
When you go to slides, I love it. So I like doing that. So
yeah,
we'll
okay.
take a break. We'll come back, continue our discussion. Be back right after this. Well, welcome back, everyone, to OpenLine. Paul Winkler is here, president and founder of Paul Winkler Incorporated. We're talking about financial planning, investing. You were showing some slides. The slides were talking about diversification. And the essence that I took from what you said was these big companies, Vanguard and the like, they say they're diversified, but when you drill down into it, they're not as diversified as they say.
Yeah, and it's not that you can't get some level of diversification with them, but when they put the portfolios together, why is it that they apparently avoid it? Because it wasn't just them. I mean, we looked at Vanguard, Fidelity, T. Rowe Price, American Funds, Voya, State Street. Now, you know, we looked at a lot of different investment companies just there and noticing that they're really concentrated and going, is this a conspiracy? What are they doing? What's going on here? And, you know, literally what I often talk about is mental processes that we deal with when it comes to investing. And one of the big ones is familiarity. What are we familiar with? What are we, you know, we've talked about that before. And we just talked a little bit about, you know, if we ask somebody what the market did, we'll hear the Dow, the NASDAQ, and the S&P 500. And we notice that those same indexes are in those areas of the market. You know, that's where they're concentrated. So if you're moving with them, your job tends to be more safe. And that's one of the big goals of a mutual fund company is get you to keep your money with them and not move away from them. And you're just more likely because, and the reason that happens is because there's so little education and coaching out there. when it comes to investing.
Right.
And I was ornery enough 25 years ago to go, you know what, I think I can educate investors to put up with a less market tilted portfolio is what we call it in academics, that you're not looking exactly like the market. And what happens in those cases, and here's where it's dangerous, when you look at periods of time like the 90s, remember the 90s, you had a tech bubble and everything's just going phenomenally well for big U.S. companies.
That was a boom time, right?
U.S. large companies were doing this, which is not unlike what we've just seen. Now,
we're seeing that now?
We have been seeing in the past few years. Not so much this year so far.
Okay.
Not so much this year. That has, but a lot of people don't realize it because the market's still up, so they haven't even, they don't even realize it. But what was really interesting in the late 90s is I'm learning this stuff, and I have this, this guy, he's an academic that I'm really fond of. I think that he's really smart. And he makes a comment that, you ought to own international small value companies. And he says that to our whole classroom. Guy's name is Eugene Fama. And I'm listening to him going, this guy is brilliant, what he's saying. And I'm sitting there going, but wait a minute, you're asking us to put our clients' money in something that had a 5-year track record of 0. Does this make sense, Professor?
Right.
And he's like, yeah, and he explains it, and I'm sitting there going, well, that does make sense that those companies, even though their 5-year return was 0, that doesn't mean that they don't have to pay to use people's money going forward. They're still going to have to pay to use people's money. And yes, we've been talking about it forever. The stock market is unpredictable. So that 5-year track record of 0 wasn't something that somebody predicted 5 years ago. It was something that just happened. So what ends up happening is, I'm going, well, okay, this makes a lot of sense. Yeah, that area of the market is something that you probably should have to be diversified, because what's diversification? Owning things that don't move together.
Right.
Don't put all your eggs in one basket. Everybody says it. Well, what does that mean? It means that they don't move together. Mm-hmm. One thing may do this while the other thing does this. That's why I spread my fingers.
And are they tied? I mean, one thing you're diversifying your risk. But if one goes up, does one automatically go down?
No.
Or generally? It's not the case.
They're typically stock markets. It's a really good question. Stock markets are normally positively correlated. So in other words, if you looked at so far this year, international small value stocks are up like 40%. But large U.S. stocks are up, much, much less than that, like 10, or I haven't even looked recently. But it's much, much less than that. But it's still up. Mm-hmm. And you look at other years where U.S. was doing this, international was up, but not as much. I was looking at it for, somebody yesterday I was looking at, and it was like the 5-year return, or 6-year return, I think it was, for U.S. large companies was like 16%, as I recall. 16% return. Well, another part of the portfolio, the smaller companies, was up 5. And you go, well, wait a minute, why didn't we, well, you can't know ahead of time. What do we know? We know that when pension plans try to time markets, try to figure out which area of the market I ought to be in, you find that they end up underperforming the market because nobody can predict the future. Markets are driven by the future. So what ends up happening, and this is the beauty of diversification, is when I own something that goes on to do this, I don't go up as much. But when that turns around, I don't go down as much either, which is an answer to the question of how do we protect ourselves from downside risk. Make sure you own things that aren't necessarily, like when you went through the downturn of 2000 and 2002. You literally had the S&P 500, large U.S. stocks. If you had $100,000 in there, you were literally at about $55,000 by the time it was all over.
Wow.
But large U.S. value companies went up 10% and up another 5% the year after that, and didn't go down that much in 2002. Small international stocks went up like 5% and then up 30% the next year. They just didn't move together, and that is the key. Now, we could say, hey, can we go to gold because that's safer? No, look at how much gold can go down. We just saw it.
Right.
We saw it in the 1980s. It went from like $800 an ounce, and it just dropped like crazy through a decade of the 80s. And you think, is that safe? And not by my definition, it's not. You know, so that's really it. It's you know, we say diversification, but we better define it way better in the academic community. In the investing world, it better be defined better than just owning a lot of things.
Right, because they would say diversification because they own Coca-Cola and Ford and whatever. Those are big companies. And you're saying you need, I guess, you know, diversification, big Coca-Cola, Ford, but you need the small companies. You need the middle companies.
The Cracker Barrels, and you know, Cracker Barrel made some bad news lately, but you know, that's a bad example. Or a Tasty Baking Company, or you know, something you've probably never even heard of.
Right.
You know, might be in your portfolio. I always say that I wanted to own Bill Gates. I wanted to own Microsoft before he made it into this huge company that really took off. I want to own smaller companies too.
Well, then how do you do that? So is Vanguard, I like that explanation, Vanguard in part, and I'm picking up Vanguard, all of those.
Because everybody recognizes the name.
They want to tie it to the stock market in a way because it's easier to explain. If it goes up, it's like, yeah, stock market's up. If it goes down, they have something to cover themselves. Well, stock market's down, and you're like, okay, I understand.
And the asset mixes typically tend to be very tilted that way.
But how do you pick, then, the small? Because I could pick large, in a way, Coca-Cola, Ford, or whatever.
It may be beyond the pay grade of somebody out there listening on how you do this, but I'll tell you how I do it. This is what I'm looking for those people that want to nerd out on it a little bit.
Sure.
So you might have a mutual fund, and what that mutual fund is it's investing in big U.S. companies. It might be investing in the 500 biggest companies, the S&P 500. But then you're going to have another fund that's investing in just maybe 200, 300 value companies, which would be totally different types of companies. Those would be companies that would be stodgy, companies you wouldn't think of as exciting. But those unexcited companies, like, you know, maybe Procter & Gamble or something like that, maybe more stodgy, more, you know, everybody needs to eat even if the economy's bad, right? So if the economy goes down and those big companies take a dive, well, these companies may actually do well, you know, and maybe just fine. Another thing that you're looking for is you might be looking at companies that are very, very small. Maybe they're $1 billion companies or something, or $1 or $2 or $3 billion companies. Those, even though billion sounds like a big word or a big number, it's actually a smaller company. And what happens when the economy goes down is you typically hear that the interest rates are going to be brought down, and when interest rates go down, companies like that tend to go up in value because they borrow money more often, and you've reduced the cost of doing business on them. So you might have value companies. You might have a smaller value company too. And then you go, okay, well, you know what? The U.S. isn't the only game in town. You know, you got 40 to 50 other countries around the world with hundreds and tens of thousands of companies. Maybe I ought to own those too, because if the U.S. falls on hard times, just maybe those other countries will do well. You know, so you can have a situation where maybe oil prices go up and it's hard to export things from a long ways away, and then countries start to trade amongst each other over there, which is really beneficial to them. You know, so those are things that you can do. You know, but you got to look at it and you go look at it and go, well, how do you define these things? Well, you'll define them based on market cap, which I said is above the pay grade of a lot of people out there.
Right.
But if the investment advisor understands this stuff, that's really kind of cool, you know?
Well, I don't know about market cap, but I understand completely what you're saying on the other thing. And something else you've said that I found interesting.
Market cap is basically this. If I want to buy the whole company, what do I pay to buy the whole company? Okay. If it's a $1 billion company and I want to own the whole, you remember the old Gillette commercial?
Yeah.
They had, you know, I like the company so much, I bought it. That's it. You buy the whole company. And that's what market cap is. You could find that based on looking at the stock. Yeah,
theoretically.
There are funds out there, and you can look at the average weighted market cap of the mutual fund, and you can buy them based on that. You know, so that's something you can do. Yeah.
When one of these companies goes down, there are people, there are real human beings there that are concerned, and their sole job is to get it to go back up.
Yeah, so that's why markets don't go down forever. They go down, but they come back up. I had somebody say to me one day, it was like a week ago, she said to me, she said, well, Paul, kind of isn't the stock market just gambling? And I said, the way most people approach it, I would absolutely agree. the way the investing world tends to approach it, I would agree. And because typically you'll see in mutual funds, you'll see turnover, buying and selling that goes on. You'll see that they're changing out that fund for that fund. They're moving things around, which you think, well, that's what I want them doing. Get rid of the bad funds, get rid of the good funds, or get us into the good funds. Well, my question is this. How did you determine it was a bad fund? It went down. Well, what did you just do? Sold low. So what did you just do? You locked in my losses. Did you help me? Or did you hurt me when you did that? And what did you replace it with? Something that's good. How did you determine it was good? It just went up. So what did you just do? I bought high.
Yeah.
And you think, well, what is that? That's gambling. Mm-hmm. You're buying after something's done well. You're selling after it's done poorly. That's not good investing. And so often that's what passes as investment advice, is my frustration. How do you choose mutual funds? Track record, 1 and 3 and 5, 10-year track record. Well, what does that mean? It's done well in the past. Does that mean it's a good thing to go and buy it now? You got around this time of year, people talk about tax loss harvesting. You know, to sell your losers and sell your gainers at the same time, offset the gains with the losses, and you can avoid taxes. Well, what are you doing? You're selling low. That may not be the best thing to do. Mm-hmm. You know, so a lot of times that's the problem. What you want to do is avoid that type of thing.
See, I find that interesting. And you've also talked about the Great Depression and how it did go back up. And we can talk about it. We have to take a break. But yeah, just that there is a great deal of work being done to move it back up.
And the depression is an interesting conversation.
Yeah, that I've always found very interesting. All right, but we need to take a break. We'll come back, continue our discussion. Paul Winkler talking about money investing. We'll be back right after this. Welcome back, everyone, to OpenLine. We are talking with Paul Winkler, president, founder of Paul Winkler Incorporated, just about investing. We're talking about investing, financial planning, money. We talked about the need for diversification. That's been the essence of what we have talked about.
A lot deeper than we ever have.
I know.
Which is great.
You had some slides, and that was great. We have a call. We'll take a call here. Let's go to Terry. Hello, Terry.
Oh, it's Carrie?
Carrie, go right ahead.
Carrie,
what's on your mind?
Hey.
Hi. I wanted to know what Paul thought about AI, because that seems to be the only thing people talk about nowadays, and if he thinks it's a bubble, like the tech bubble back in the day.
Yeah, good question.
And also if, like, you were talking about gold, when people used to go mine for gold, the people who actually made money was the people who sold supplies to the miners.
That's right.
So is there something in that with artificial intelligence, because the chips, particularly NVIDIA, like the stock for NVIDIA is like so crazy high. Is there something that you could go beyond from the chips that would maybe, I don't know, it's just a thought that's been rattling in my head lately, so I could just hear what he has to say on that.
Yeah, thanks, Carrie. Yeah, that is fantastic. She's actually using a metaphor that I've often used. That's brilliant. She's actually using something that I've talked about, where who made all the money with the gold mining? It was the people selling the picks and the shovels and the tents and all of those things. You know, so the same thing goes with AI. Who makes the most money on that? It's, you know, where, as far as who will benefit the most? Well, anybody, everybody, all companies will benefit, because if you look at what causes a stock to go up, the earnings going up is what causes it to go up. Anything that AI touches can help the earnings of a company, because it can reduce the cost of doing business as far as productivity, increasing productivity. It can reduce labor costs. It can, you know, take maybe somebody's job that's redundant, and then instead of having so many different people, and that, you know, but it doesn't mean people will necessarily lose jobs. They're not. That's the interesting thing. It's actually taking a situation that we're dealing with right now, which is untenable, which is that our birth rate isn't high enough, and it's just getting us through that, where we can actually do the same that we were doing before with less people. But what happens with AI, and you look at this and go, do I go and invest in these companies? And my question is this: do you think these companies are good? Absolutely. They're great. They're well capitalized. They're really solid companies. The question is, do you think they just can't wait to pay you more to use your money? No. No, they're not just sitting there going, man, I just want to pay Paul more to use his money. They're not sitting there doing that. I want to pay Carrie more to use her money. So in reality, the long-term expected return is lower, just as it was with the tech companies, because those companies actually are very high-priced compared to their earnings. But it is who uses their products that will tend to benefit the most. And it is the same thing. An example that I often use is it was RCA. I was telling one of my guys today about a story. There was a guy that told me about RCA stock. In the 1930s, RCA, Radio Corporation of America, was the future of the United States radio. Absolutely, no question about it. The stock got up to a point that it literally never reached that point again for the next 90 years.
Oh, man.
It literally got bid up so high, and still people listen to radio, but it literally got bid up so high because people were so excited about the future of radio that they bid it up, and then it just languished for the next 70, 80, 90 years.
That is then the perfect example of
Yes.
what we may be seeing with some of these AI.
Yeah.
Because what you mentioned NVIDIA, where is that? Is that like it's really high right
Stratosphere.
now? Stratosphere.
Yeah, it's the largest
So you
company
buy
in
it,
America.
And maybe you hope it splits and all that stuff. I don't know how
And
that works.
splits don't matter a hill of beans. That's another thing that people,
Really?
Yeah,
Yeah, 'cause
that's
I was
something
always
that people
told,
miss.
yeah, you
When
want to
I have
split
a
and
pie,
divide and
if
all
I
that.
have a pie and I split it in half, I still have a pie. Let's say that this pie is $10, then I have two pieces that are $5. That's all that's happened.
Mm-hmm.
It doesn't really mean anything.
Mm-hmm.
It just makes the stock more affordable or smaller, for the average person. But it does not mean anything about future performance. And another example is who invented the cell phone? Motorola.
Okay.
Motorola.
Okay.
How many of you are carrying around a Motorola cell phone in your pocket? Who invented the digital camera? Kodak. How many of you have a Kodak digital camera?
Yeah, they're not around.
Nobody.
Yeah.
So, maybe the company is good, but there are so many people and so many companies vying for the business. Literally, quantum computing. In the past couple of days, quantum computing, which is all the rage on, the future of computing, those stocks have actually dropped 30% in the past couple of days. And it's like, whoa, wait, and that's how fast these bubbles can pop.
So those are bubbles. I mean, that you would use that word? Because I remember the dot-com bubble.
We don't know except in hindsight that it was a bubble.
Okay.
Yeah, let me
that
be
makes
clear
sense.
about
You don't know
that.
in hindsight it is a bubble. But the dot-com bubble was something along the lines of you could put a stock out there, something.com.
Yes.
And it maybe hadn't even done anything yet. But people were betting that it was going to be successful just because it had .com.
Yeah.
And so the price would run up. Then the company wasn't very successful. And it would crash.
Or had no market, no product. They had nothing really. But, same thing happened in the 1960s. Nothing's new under the sun. In the 1960s, all you had to do was put Tronics on the end of your stock name, and it was good for a boost in your stock price.
That's funny.
So it's the same thing. So, Carrie, that's a great question.
Yeah.
The whole idea of AI, is it something, should I chase it? And that's exactly what you're doing. You're chasing something. Just recognize that all companies out there, everybody, self-included, I actually use AI a lot of times in my practice to make the company more efficient. One of the things I love using is quite often I'll sit in workshops and I will record using AI the workshop, and it will give me a summary of everything that was talked about so I can remember exactly, well, how much time did I spend doing this, and how many times did I have to go re-attend a workshop just to remember what was talked about because I didn't have time to take all the notes.
But then are you investing in AI companies, or are you going to wait and see which company comes out on top?
They are in my portfolio, and here's the cool thing. They were in the portfolio before they were something. Mm-hmm. They were in the portfolio, so I benefited from their run-up before it happened. That was because, remember what I said, I wanted to own Microsoft before Bill Gates pulled it out of his garage. And that's my philosophy. That's why we want to own companies that you just don't typically find very well represented in people's investment portfolios. And the beauty of it, you think small companies are risky. Yeah, but the beauty of it, and this is what academic research shows, and the evidence-based research shows that when we put that in our portfolio, it tends to drive down risk because it doesn't move with the other things in the portfolio.
So then, if I were looking to invest right now, those AI companies, they might be a little high. What is the small company on the horizon that maybe, are there some areas, maybe not individual companies, AI, the ship has sailed. I mean, maybe it's really big up there. Somebody's going to get fabulously wealthy, but we don't know which one. They're all fighting over it. Somebody may not. But what are some areas, I guess, that you're looking at as far as small companies in the future that might really take off?
Well, when I'm investing, do I own companies like NVIDIA? Do I own companies like Apple and Microsoft? Absolutely. But it's such a minute portion of my portfolio. It's not that I don't invest in them. But literally, if you looked at my portfolio and say, hey, Paul, how many stocks do you own? How many are in your portfolio? It would shock you. It's somewhere between 40 and 50,000. So you get the point.
So that's diversification.
That is diversification.
Wow.
That is being well mixed. It
sounds like it's not a lot of time spent poring over newspapers going, oh, the next big thing is X.
Yeah.
You don't have to worry about that because you're just investing in lots of next big things. Maybe. Mutual funds that have lots of stuff.
And ETFs, yeah, mutual funds, ETFs. But the philosophy of the mutual fund has to be that we're not trying to figure out which companies are better than others. It's not, we're owning them all without saying, I think that this company is going to do better than that one right there. Recognize that every single company out there, publicly traded, all have to pay to use your money. Will some of them go down? Yes. Will some of them be fabulously successful? Yes. Historically, that's exactly what happens. But I don't know which ones, and I can't know. And that's my beef with the investment industry, is so much of their time is spent doing that. You read their prospectuses, you read their ADVs, you read their reports. They say, what are we going to do? Fundamental analysis, technical analysis. They're saying that what we're going to do is we're going to try to check out the fundamentals of these companies to determine. And that is why your question is on everybody's minds, because they think that's the job of the investment advisor. Right. And I've been screaming at the top of my lungs for 25 years that no, it's not. Mm-hmm. It's not the job of the investment advisor. The job of the investment advisor is make sure that the mix between these things is proper and make sure that the vehicles that we're using are capturing the market returns of those particular areas.
So if you sit, and we have to go to break, but if I sit there and ask my investment advisor, is this a good company? And he says, well, I have this formula, and this formula says yes or no, that might be suspect.
Yeah, run.
That would be
run. Get your Nike shoes on and run.
Interesting. Okay, we'll take a break. We'll come back, continue our discussion right after this. Welcome back, everyone, to OpenLine, here with Paul Winkler. We don't have a ton of time in the segment, so we've hit on a lot of stuff. Bottom line, you want people to take away what?
Yeah, so a lot of the stuff I talk about, the investment companies aren't as diversified as they ought to be, in my humble opinion, and we talked about that a lot. There was a guy that about 3,000 years ago, he wrote this, and I'll do it from memory. It's put your money into 7 to 8 places you don't know what calamity will befall the earth, which is really interesting because the academic research, the evidence-based research now shows that you have large value, small value, large growth, small growth. You have cash, short-term bonds, and intermediate bonds. Typically, those 7 areas are what make up a diversified portfolio, number one. Number two, he talked about don't watch, he who watches the wind won't sow, he who watches the clouds won't reap. Don't look at what's going on in China, what's happening here, or happening there, what's happening in AI. Don't look at that. That's market timing. And plant in the morning, plant in the afternoon, because you don't know whether one will do well or whether both will do well. And the reality of it is that's dissimilar price movement. And, it's interesting because Nobel Prizes have been awarded for that particular work.
So that was diversification, essentially, 3,000 years ago. That's the message.
That's exactly right. Solomon wrote about that. And it was diversification, and it was modern portfolio theory, which was 1990 Nobel Prize winner. How do you put things together to reduce your risk? And everything is driven by time horizon. Should there be somebody that is all in cash? Yeah, if you need all your money back in a year, you might be all in cash. But there are gradients of stocks versus bonds and fixed income income investments that are dependent upon what your time horizon is. So how old you are, how much you need, how much income do you need, when do you need it, and when are you going to retire? That drives the investing process. But watch out for the gimmicky sales presentations on gold and Bitcoin and AI stocks and all of that stuff, because that's exactly what it is. And diversification is a sales pitch. Unfortunately, it has become one.
Oh, really? And when you ask somebody, what about this stock? And they turn around and they calculate, well, this stock is good, you're saying run.
Yeah, because, no company wants to pay more to use your money than they have to. So individual stock investing is a really bad idea, because you're betting that one company is going to do well versus its peers. You might have a Home Depot does really well and Lowe's goes out of business, or vice versa. The reality is I want to own them both, because I don't know which one is going to do well. And that's, maybe an oversimplified example, but, I don't know which industry is going to do well. Is it going to be energy? Is it going to be technology? Is it going to be consumer durables? Is it going to be electronics? What is it going to be?
And you have many thousands, and that's the blueprint.
Yeah, it blows your mind, doesn't it?
Yeah,
that
it does.
Own between 40 and 50,000. Yeah,
that many companies. That away. Yeah, that's very interesting. All right, we'll take a break. We'll come back. We'll give out some more information how to get a hold of Paul Winkler. We'll be back right after this.